Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I want to find out what's happening with mergers and acquisitions in today's marketplace, given COVID-19 and stock markets at a high and interest rates at a low. And so I wanted to check in with someone who I've interacted with a little bit over the past. His name is Mark Borkowski. He's president of Mercantile Mergers and Acquisitions Corp. It's a Toronto-based M&A company. Mark, how are you? Welcome to our show.
Thank you very much, Brian.
So, Mark, how did you get into the M&A business? Tell me a little bit about your background, sir.
Well, electrical engineer, MBA. I started my career at Hewlett-Packard as a sales engineer. I left and did a technology startup with three other engineers from HP. Company went public 35 years ago. I left, not on good terms with my partners, and I went out to try to acquire a business. Didn't find anything that I was interested in. However, I brought two clients together and I sort of worked through a transaction. That was 34 years ago. And I hung up my shingle as an M&A intermediary. We've consummated about 196 transactions in the mid-market. And we operate out of Bay Street, 1 King Street West for the past 34 years.
Fantastic. Sounds good. And you specialize in the mid-market? Strictly
the mid-market. We were named by Axial, the Axial Network, which is the largest network linking all the private equity and M&A industry together, as in the top 20 lower investment bankers in North America, the only Canadian. Ha ha ha.
Now tell me, what is the mid-market?
Mid-market are companies that generally do between $1 and $10 million of EBITDA profit. So any company that would do at least $1 million of profit up to about 10 million would be considered to be what would be the lower mid-market.
And then give me a sort of an ecosystem. Below that is what? Small business?
Small business below that, probably.
And above that is major corporations?
I'd say that would be, by US standards, they call that the mid-market, not lower mid-market. So, I mean, to Canadians, that would probably be, I mean, our focus is a little bit smaller than the American.
So 1 to 10 million of EBITDA, and then 10 to what would be the mid-market?
They would consider 10 to probably, by their American standards, 10 to $100 million of EBITDA would be considered mid-market by the Americans. Probably $500 million and up would be considered to be their large deals. For us, that would be a mammoth project.
And people say that 70 to 80% of businesses are small and medium-sized businesses, and the vast majority of people are employed by small or medium-sized businesses. How big is the mid-market? $1 to $10 million of EBITDA, do you think?
By Canadian standards, that represents probably about less than 30% of the Canadian market. The vast majority, by Canadian standards, would be below that plateau.
Really? And yet the vast majority of investment banks, if not all investment banks, would be focused on the greater than $10 million of EBITDA, no?
Everybody's looking for the big deal. And I mean, all the private equity firms are looking for companies that are earning somewhere between, these days, 3 million to probably $10 million of EBITDA. It's just as much effort to do a big deal as it is to do a small deal. So you'll find that the institutional capital providers, of which, by the way, in Canada or in North America, I should say, there are probably close to 20,000 private equity firms. Of that, there would be 4,000 private equity firms and institutional investors, including family offices, that would have at least $1 billion of captive capital, available money to invest. They're at the moment estimated by PitchBook, which is the authority that monitors our industry. It is estimated that there's now about $1.8 trillion of what they call dry powder. $1.8 trillion
of dry powder
sitting in funds not able to deploy. Lots and lots and lots of money and nothing to buy.
Why is there so much money rolling around?
Pension funds, insurance funds, family endowments, high net individuals. There's an incredible amount of money in the system. And again, I repeat,
how can you have that when the stock market is an all-time high?
Stock market all-time high, and they seem to correlate. I mean, There's no
One would
real
think that
connection.
the stock market to be at an all-time high would have already had to have taken all that money into it as investments.
Again, there's all of these sources of capital that are not going into the public markets. They're not going into real estate. They're not going into the public markets. They're looking today, probably the greatest investment opportunity is to invest in private equity. So these private equity firms manage money. They in turn invest in private companies and help them grow.
So if the stock market is an all-time high, why is there such interest in investing in private companies?
The returns are superior. I mean, we know what the returns generally are. You know, on the S&P, you can get it. You get a pretty strong plateau of where the S&P sits. Private equity have been getting return on equity in excess of 23 to 24% annually across the board. Returns in the stock market have been great, but probably would be closer to 9% on average. Private equity is the place to be. Private investing in private companies is the place to be.
We're chatting today with Mark Borkowski, the president of his own M&A company, and we're talking about M&A business. His company is called Mercantile Mergers and Acquisitions Corporation. We're going to take a break and come back with more of Mark's thoughts on the M&A business and private equity in just a minute. Stay with us. Welcome back. We're here with Mark Borkowski. He's the president of his M&A firm called Mercantile Mergers and Acquisitions Corporation. He's been in, I think, Mark, you said 35 years?
34.
34. I'm counting. I'm ahead of you. Sorry, you're ahead. So you were saying that private equity is the place to be. Do you invest people in private equity company, or do you just help the mergers between different private equity companies?
So we are an intermediary. We are what was referred to as a sell-side intermediary. So we represent companies who are seeking to sell their company. And you know, these relationships take a very long time.
Sell the whole company, not just investments in the company.
Of course, there's two approaches to sell the company: sell the shares or the assets. So we are seeking to sell companies. Of the 5 sell mandates that we have at the moment, all of them are retirements. Matter of fact, all organizations have been in business for at least 40 years or longer. So for those companies, their ideal buyers are one of 2 buyers: the strategic buyer, who are generally competitors or companies in the industry, or the private equity firms. The private equity firms react very quickly. They're managing capital on behalf of pension funds, insurance funds, endowments. So they're focused on acquiring and making an investment. The strategic investors, the strategic buyers, the competitors, they take much longer, but they generally are a better fit. In those cases, 1 + 1 gives you 3. However, some of the private equity firms that we're dealing with own 60 or 70 companies. And within those portfolios, they have companies that also provide synergy. The objective is, in all these transactions, is to get that 1 + 1 = 3 equation, add value. So as opposed to just selling a company and having a buyer leverage it to death and be paying off interest for the next number of years, we're looking for the ideal fit, that there is some synergy between companies, so that what's left is an organization that will grow further.
So do you typically get a premium from the strategic buyer over the private equity buyer?
These days, the private equity buyers are outbidding themselves. In our last project, we had 161 responses to a posting that we did through the Axial Network, which is the network that linked all the PE firms. Of that, we ended up having 11 proposals. And from that, we had 4 competitive bids, of which the final bidder was a group out of Atlanta that paid a significant premium.
That's an interesting funnel. Let's just talk through those numbers again and see if that's sort of typical. So you had 161
responses to a posting. So we did a distribution to all the strategics. We sourced them through a database that we subscribe to. It's a very expensive database called PitchBook. Another one is called Preqin. We posted on that network. We secure all the companies who are in that industry. So in this last particular case, we sold a company that was in the packaging industry, and they had a couple hundred employees located in Southern Ontario. we posted this on the Axial Network. We sourced out all the competitors, which I think we found about 113. We sent it out through that network, and we sat back and waited for the response.
So you're sending it out to a far wider universe than the 161.
Correct.
But you got 161 responses.
Correct. We sent it out to an international network.
And so we have that like over 1,000 probably?
More than that. I mean, on the Axial Network, it reaches about 20,000 private equity firms.
And 113 were direct competitors.
Direct competitors are strategic related companies to that segment of packaging.
And then will you also, make direct approaches to private equity firms, or no, just through the network?
We work through the network plus my contacts. I have personal relationships with about 71 private equity firms that have an interest in packaging. 71, 161 that responded, 20,000 PE firms. I mean, we
okay, and so then so a big universe, you get 161 interested people that have responded.
Correct.
And from that, you got, what was it, 13 you said?
11. We screened it down to 11. I mean, we were very careful in terms of who we were dealing with.
So often people think about a 10-to-1 ratio. Your ratio is even, wider than 10-to-1. You're
correct. I mean, again, it has the fact to do that there's just a lot of very interested parties that have this dry powder.
Right.
So, I mean, our phone never stopped ringing. I mean, of that whole group that we eliminated, they kept coming back. And
with that narrow group, are they all getting management presentations and going through the data room and doing due diligence?
We allowed only the 11 to have presentations. We made presentations. We, in this particular, had Zoom calls with 11. They had access to the data rooms. We set up a data room, of course, where we provide all the information. We can see who's monitoring what, who's seeing exactly what information. And we brought it down to a group of 4. And we played one off the other. We consummated the transaction on January 31st with a group that, provided the very best fit and paid a premium, actually.
And so tell me, how do you get from the 11 to the 4? The 4 ones that you're actually negotiating contracts with, or you got bids from, or what?
We received letters of intent, of course.
Not from the 11, but from the 4.
From the 4. We received letters of intent from the 11, and we eliminated some. We brought it down to 4. And of course, it's easy to manage the 4. The very best offer in the eyes of a company seller is how much cash up front am I getting, as opposed to vendor take-back notes or earnouts. Earnouts, of course, are we'll pay you if it comes. That's what an earnout is. So, some of these companies will offer the highest value, but they'll offer very little cash up front and more if come or more vendor take-back notes, which obviously provide a little bit of risk.
Right.
To a potential seller.
The funnel that I had talked about previously when I've been in the VC or P world is that you have to make 1,000 approaches to get 100 interested people, and you have to have 100 interested people to get 10 bidders, and you have to have 10 bidders to get 1 successful. And that's sort of
it's pretty close.
Your funnel is maybe wider at the top.
We're probably a little bit wider at the top because we use all the databases that are available. I mean, there's an international market out there.
Yeah.
I mean, we are surprised at how big and how active Europe is. I mean, the Europeans aspire to be in North America. So they're participating in all these bids. It's not the Orientals, not the Chinese. At the moment, the Germans, the French, the Italians see the opportunities in Canada and North America, and they are here. They'd be here if we were not closed. So currently we're doing Zoom calls.
Yeah.
And they're very logical buyers. They add value. They bring value to this market. They bring their technology. They bring their know-how. They bring their capital.
Let me ask, I'm sticking on this funnel for a second, if I could, Mark. Auction. And I've had it described to me, and I want your reaction to this, that to have a good auction to get your best price, you've got to have more than one bidder, because one person doesn't make an auction. But if you have more than 5 or 6, it doesn't work, because to have a good auction, the people that are in the auction have to believe they've got a reasonable chance of winning. And if it's too many people at the final auction table, they don't think they got a reasonable chance of winning. So you got to narrow it down to what you had with the 4. What do you think is the right Like, what's the right structure for an auction in the end?
I mean, the right structure for an auction is you start with a large number, as you say. And by the way, the number you're using, Brian, is absolutely correct. You start with 1,000 and through your funneling, you bring it down. The ideal auction is that you bring it down to 3 or 4, ideally 3 groups, sometimes just 2, but they know that they're competing with another group. I disclose up front who, without names, of course, that there are 3 other groups or 2 other groups working through this process with us. And for those that have great interest, they recognize that. The private equity firms are accustomed to being in auctions. Remember, lots of money, nothing to buy.
Now, I keep running into people that say, I don't participate in auctions. I don't participate in bids. I want proprietary deal flow.
We all want proprietary deal flow. And there's certain groups that we know are very motivated. We know will be very serious. We know that they'll have they'll pay the premium or close to the premium. So we will present it to them and say, first, exclusive, or not first, but exclusive to you. Spend 2 weeks evaluating this opportunity. We don't want you to be participating in an auction. We want you to know that this is being presented to you. Give us feedback. You've got 14 days. That's proprietary deal flow. So we will do that in certain transactions and certain mandates.
Sounds like you got a fascinating business, sir.
Thank you. It's been fun. And at the moment, honestly, in 34 years, we have never been busier. Why? People don't have confidence in the future. I mean, I've been talking to people. It takes a long time to get one of these sale mandates. I've been talking to people for 12 years who've been talking about retiring, selling, second generation. Suddenly, many of these groups don't have confidence in the future. They're seeing what's going on, and some might be selling at the wrong time. I mean, value.
Yeah, that's interesting, Mark. People don't have confidence in the future is what you're saying. At the same time, our stock market is an all-time high. Interest rates are an all-time low, which would suggest that people have got, in the market, huge confidence in the future. Our real estate market is booming. People would suggest have huge confidence in the future, even though, debt is high, debt to incomes are at an all-time high, et cetera. What's going on?
There's absolute positive momentum in the stock market. Real estate is burning. I'm sure you must have heard some of the Toronto reports about Toronto real estate. It's out of control. Private owners have private agendas, and many are taking the option to say, let's take our chips off the table now. Some don't believe.
If private owners are saying that, is that a leading indicator of what might happen in the public markets and real estate markets in the future?
Absolutely. I mean, if you talk to smart money, and again, these are very smart people. These are private owners, many who are worth 30, 40, 50 million dollars, who've accumulated a lot of wealth, who've built businesses. They seem to be the canary in the coal mine. Many see a bubble coming, and the fact a lot of it's connected to
not a bubble coming, the bubble burst coming.
The bubble burst, exactly. The bubble burst. So the bubble burst in the eyes of these people, and you can sit with these people, and they will tell you privately, we do not have confidence. Well, you say, well, what does the forecast for your business look like? Well, it looks good, but we personally don't want to stay in the market. We'd rather get our money out and move on.
But then they're going to have the same problem. But where do they put their money? It's going to be more of that 1.8 trillion that's exactly washing around. And what am I going to put my money in? Real estate. Oh, yeah.
I'll tell you, the most successful company sellers in 34 years, and I'll give this as honest commentary, have been company sellers that took their chips off the table and went out to become real estate developers. Those that went back and bought another business, I would say about 60% of them did not succeed. The company owner that says, he's pounding on his chest,
I can do it again.
I can manage anything. I can do anything. Well, guess what? They were very successful in their original business. They acquire another business and they apply the same techniques. And as I say, 60% at least do not survive.
But why real estate? Just because it tends to appreciate?
Real estate has been very stable. I mean, it's probably one of the most stable investments. And particularly the people who add value. Yeah. I mean, the amount of development opportunities in Ontario, are great. And across the board over the past 40 years, real estate has been probably the most dependable investment. However, private investing in private companies by far exceeds returns on real estate.
But it's riskier.
But of course it's riskier. You're operating a business. You're taking on debt. You're hiring people.
I've talked to a couple of high net worth people that have been owners of big properties or big companies of late that are really worried that capital gains tax is going to go up, that it's got to go up because of the debt situations that we've created in North America, given the COVID-19, deficit financing.
Brian, you're 100% correct in that. I'm not sure what to comment on debt in general. I mean, debt is the killer to all of this. And let's talk about the capital gains exemption, for example. The small business capital gains exemption at the moment allows a seller who owns the shares of a company, who sold the shares, the first $850,000 is technically tax-free. If there are two shareholders in that company, it's $850 times two. If there's three shareholders, it's $850 times three. So the small business capital gains exemption was originally set up to have these owners take money off the table tax-free. And the objective was that they would reinvest it in another business. Well, actually, that's not happened. So the capital gains exemption, the small business capital gains exemption right at the moment is under great review by the Trudeau government. I don't have the exact number, but what it cost, I think last year, was something in the range approximately of about $70 billion of lost tax revenue by allowing this capital gains exemption to be existing. However, there's two ways to sell a business. You can sell the shares, or you can sell technically what's called the assets. So no seller wants to sell the assets of their company. Why? Number one, they're taxed at the full tax rate. So let's say the guy takes $10 million off the table. He will be taxed at 52%. Secondly, on an asset deal, he has to sever all of his employees and pay them severance. Why? Because they're going to start off as day one employees. So the new company says, we don't want the liability of these people's backgrounds. And in case we don't like them, Joe's been here for 27 years. That means we're going to have to pay, if we terminate Joe, by standards today, we'll probably have to pay him 27 months of severance. So as a day one employee, we have no potential severance liability. However, in the case of the owner, not only is he paying at the full tax rate, he's now having to sever his employees. I mean, there's not a lot of net proceeds to him. So everybody is trying to maintain the share sale. Number one, to gain the tax-free status, 850, plus to avoid taking on the severance liability. Share versus asset.
And yet the buyers want to buy assets, not companies.
Buyers don't want the liability of the employees. Buyers don't want any particular history. I mean, there are potential lawsuits that have been bubbling in some of these companies for 2 or 3 years. There might have been a dispute with a supplier that took place in 2018. There's been back and forth correspondence. Suddenly, it bubbles up as a lawsuit. Guess what? The buyer, if he's bought shares, it's his issue.
We're chatting today with Mark Borkowski, the president of Mercantile Mergers and Acquisitions Corp. We're going to take a break and have some messages and come back with Mark in just a minute. Stay with us.
Thank you.
Welcome back to the Brian Crombie Radio Hour, Saga 960. We're chatting with Mark Borkowski about mergers and acquisitions and what's going on. Mark, you've suggested that there's a whole bunch of money chasing acquisitions. You said there's $1.8 trillion of dry powder out there that you're getting incredible amount of interest, not only from Canada, but around the world if you're selling Canadian companies. What's happening to valuations today?
I mean, I can't express the fact that along with all this demand and all this capital, valuations have risen. So we've seen values go up probably in about the last 2 years, and they're rising. But it all starts with expectations. I mean, before we go to market, we sit with obviously a company owner and decide value. Valuations, you can do valuations one of two ways. It takes us about 3 hours to do a proper valuation. We do something what's called a normalization of income. So we'll take the financial statements, and I would say that 95% of all company owners don't report the real net income. There's all kinds of fat and extras that are taken through. So we come to a normalization of
CRA
income.
would love to hear that.
Well, so we do that privately, and we come up with this normalization of income. From that, we determine a multiple of value for that particular industry. These days, for a company that earns, say, let's pick a number, $1 million of earnings before interest, taxes, and amortization or depreciation and amortization, $1 million will probably command a value of about 5 times that number. So a company doing $1 million of revenue, 5 times would be valued about $5 million. Of course, there's some assets and capital, working capital that needs to be left in the business, but you're looking at a value of around $5 million.
So 5 times EBITDA isn't such a lofty number. I was seeing debt deals being done at 3 to 5 times EBITDA, which would suggest that hopefully the market value is in excess of that. Is 5 low or is 5 high?
5 is probably the median. I mean, there are transactions for very, very desired businesses where they have auctions. There was an auction in California for a company in the food business that ended up trading for 12 times EBITDA, and I mean they had something like 67 or 70 bidders.
Unbelievable.
Yes.
So I went to business school. You went to business school. We all learned how to do a net present value, a DCF, a projection, a terminal value. You don't do that. You just do multiples of normalized cash flow?
We do all of them. But probably the most common and the easiest to come to sort of terms with, without going into a lot of detail, because a lot of these company owners don't understand, net present value and whatnot and DCF. So we do a multiple of earnings. And we suggest to them that they get a second, third, or fourth opinion. So we will give them an expression of value. We'll give them all their information back. We don't take anything with us. We say, we've done this analysis. We hand it back to them. If they'd like to do a proper valuation, I mean, there's a cost. They can go to any of the major accounting firms or professional valuators that will give a valuation. I stand behind our valuations. We're within usually between 5 and 7% of any value that's been posted. I think we have a pretty good handle on what.
Now, this 5 times EBITDA that you come up with, how do you do that? In the real estate market, the big real estate companies will publish on a quarterly basis sort of cap rates in the marketplace. If you go to the stock market, you can see at what EBITDA multiples or earnings multiples companies trade at on average. How do you come up with your 5 times EBITDA?
That's the industry standard. I mean, it really relates back to return on investment. I mean, some companies can bear a higher value because they see some synergies of operations. So they will acquire the business at 6 or maybe 7 times EBITDA, but they see the value that, putting 1 and 1 together, they can see that return on investment.
Okay, so a 5 times EBITDA multiple would mean that you've got a 20% pre-tax return.
20 or higher.
What? Well, no, 5 times would be 20% pre-tax.
Correct. Exactly correct. And in cases, again, where there's some synergies, they will, through their modeling and through the work, the analysis they're doing, they may recognize 30, even higher percent.
Okay, so you get some synergies over time, but just based simply, if it's 5 times normalized EBITDA earnings, then you're asking for a 20% return pre-tax. But you were telling me that people's returns are in the 20% after tax. So what is it? Is it leverage as well that gets them that higher return?
Absolutely. I mean, money is so cheap. I mean, the banks, I mean, you can borrow money at the moment. It's debt is cheap. It's never in the history of my life or your life where debt has been this cheap.
Okay, so if you're buying at 5 times EBITDA, what can you borrow? 3 times EBITDA?
3 times, 3 to 3.5 times for some of the aggressive U.S. lenders.
And so therefore, and the debt is what, 5%, 10%?
Average right now on return is about 7%.
Okay, so if I've got 3 of 5, the 3 multiple of EBITDA of the full 5 multiple of EBITDA at 7%, the next 2 is going to be at above 30% to weigh down to the 20%.
Correct. And of that remaining portion, there has to be some equity, obviously. So the funds or the investor or the buyer will put up a certain part of equity. He will then look to the seller and say, look, seller, you have to take a vendor take back note. Or, you know, you had a bad year in 2020 due to COVID. So we're going to a portion of that payout is going to be based in an earnout. An earnout means when we earn it, we'll share the upside. And there's 3 ways to do an earnout. We can talk about that if you like. So at the moment,
what are the 3 ways to do an earnout?
All right. So first of all, if you're doing an earnout, we start with the most common, which is we share the profit at the end of 1 or 2 or 3 years. Very difficult to manage because the buyer can load up the expenses and say, well, we need a son-in-law and an extra manager. So at the end of the term, well, we made no profit. Sorry, no earnout. Very difficult to manage, but in large transactions where there's audited statements, it can work. Second approach is taking a percentage of what we call the gross profit or the gross margin. Again, a lot of reporting, very difficult to manage. The most common earnouts today are what we call as royalties, percentage of the revenue up top. So we'll say we've given you a price of 5 times EBITDA. We've given you 70% cash on closing. We've asked for 10% as a vendor take back note, which we will be subordinated to our bank borrowing, not the mezzanine lending, but behind the bank. We've given you this note. We're going to pay it out over 18 months or 12 months, and there'll be a portion that will be an earnout. So if you are successful and you claim that 2020 or 2019, whatever year, is going to be as good as 2021, you will get that portion. And by the way, if you exceed it, there's no cap, there's no floor.
But if you're paying for current earnings, shouldn't that earnout be on incremental revenue, not just on all revenue?
It's based on revenue and incremental revenue. But some will say, no, we're going to cap it. Most transactions will be based on no cap, no top, and no floor, so that we set a number as a base number.
I hear a lot of people are doing convertible debentures. What's that?
Wow. That's simply a form of, of converting debt to equity or the other way around.
So it's a way that some people will finance a buyout. Is it
correct?
Not?
And if they have a convertible debenture, they'll be securing an interest rate, and they'll sit there as the lender for the most part, and they have the opportunity in those cases to convert to equity. So they can move from securing a debt instrument to now becoming a shareholder technically in equity.
What other trends do you see happening in the M&A business right now in the mid-market?
Trends, there's nothing to buy. I mean, there truly is. There's such an intense desire to put money out, and by the way, that's been the case for many years. But there's this appetite right now to invest in private companies because the stock market's got limited returns, although it's doing very well. Real estate have definitive cap rates. I mean, real estate returns are pretty narrow. The greatest opportunities are in private equity. So the mid-market is burning. And
so the key then is I guess you going out and finding those people that want to sell.
Correct.
And how do you do that?
It's taken a lot of years of relationships with private owners to trust you, to want to work with you, to gain that trust. So, I mean, we're well known in the market. I attend all cocktail party or pre-COVID, all cocktail parties, all events. And frankly, the little secret is that I have published over 2,000 articles in trade magazines. So we spend a lot of time dealing with companies in all the trades, electronics, manufacturing, so placing articles in those trade publications, going to the conferences, going to the shows, attending the webinars builds relationships.
So you get your name out, you get your reputation out, you get your expertise out, and from that's your marketing that gets you the calls.
Exactly. What I should tell you is that I think everybody's in the M&A business. The accounting firms, the lawyers, they're all looking for extra income. Virtually everybody we talk to is putting a deal together or hoping to put a deal together. So there's a great deal of competition for a very limited number of these private businesses. Yeah. How many private businesses in Toronto make $1 million of profit? Much less than you think.
Really? So
Absolutely.
most of them are below $1 million.
Oh, absolutely. I mean, many just make many of these smaller companies do nothing more than make a base income for people.
So, while it's challenging, you've still got to have a great business, because the vast majority of banks and even accounting firms, I would have thought, are focused on the big fish. And, tough to get those bankers' attention, because they've got an infrastructure structure, an expense structure that is so expensive that they can't afford to deal with people the size of the people that you're dealing with.
Brian, you're absolutely correct. That used to be the case. Today, RBC as a bank, Royal Bank, do the biggest of the biggest deals in Canada and internationally. They have a very large, call it M&A organization. However, they've moved to the mid-market, and now they've moved even to the lower mid-market. They have an entire group of about 16 people that compete with us across Canada. Actually, RBC mid-market M&A just consummated a beautiful transaction in manufacturing, and their cost structure, their bank, they're competing at all levels at the moment.
Really, that's interesting.
Everybody's doing deals.
So the big guys have got to come down market.
They are coming down market, because how many big deals are there? This morning, you probably saw the announcement that Air Canada have walked away from the Transat transaction. They just walked away. How many big deals of that sort are there?
Yeah.
Not many.
Now, tell me about private equity. You say that there's $1.8 trillion of dry money, that I think you said 8,000 private equity firms?
There are 4,000 private equity firms that have $1 billion of captive capital in their fund. $1 billion in one fund, looking to deploy that within a year or two. $1 billion.
4,000 in North America.
Correct. $1 billion.
Or more.
4,000 private equity firms, and they refer to as family offices as well.
Right. And
family offices are usually companies that have a multiple of companies.
And there's got to be a lot that have got $500 million or $100 million.
Oh God! According to PitchBook, there are about that have about $500 million. I think there's 16,000 that manage at least $500 million of capital in North America. Okay,
so the typical private equity deal used to be, please correct me, whatever the sort of standard is now, is they would have a 2% fee on the money they manage, and then they get 20% of the profits. Is that sort of the typical private equity deal?
Absolutely correct. However, the big general partners, the big insurance companies, the big pension funds who provide this money, who give this money to these firms to deploy it to the private equity firms, have squeezed it down in some cases now to 1.8%. So out of that 1.8%, these people have to pay their employees. They have to cover all legal fees, accounting fees, all transaction fees. So they have to be pretty astute. Yes, they get an upside. 20% is a carried interest on these opportunities, but it starts with operating from 2% on average. Used to be, by the way, 3%. So these guys could travel around, go to lunches. And by the way, they have to travel to see deals. A Canadian private equity firm if they're based in Toronto, will be doing transactions all across North America. The Canadians are doing more transactions in the US than they're doing in Canada.
Okay, but if you've got $1 billion under management,
yes,
you've got a fee every year
of 2%,
$20 million.
Yes. Now they may have to deploy $1 billion. You might have a staff of 12 or 15 people and support people to have to be able to put that out.
Okay, 15 people times 200 or 400,000 bucks doesn't come up to 20 million bucks.
No, but again, transaction fees, legal fees. The transaction we were involved in last year had legal fees of over $400,000, about $130,000 in tax and accounting, $500,000 to do a transaction. So their money, $20 million, believe me, after you've paid $500,000 in one transaction, legal fees or accounting fees, goes pretty quickly. Remember, private equity is a higher calling. A lot of these people have MBAs. For some reason, probably one of the highest paying professions is in private equity. Some of these guys, in New York, a 31-year-old can make $1 million a year. However, if you haven't seen the Goldman Sachs report, Goldman Sachs analysts complained last week, and they got media in the Wall Street Journal that said, we refuse to work 100 hours a week. We're asking to only work 80 hours a week. So all these young Canadian MBAs that go to New York and Chicago, they burn these kids out, but they pay them very well because they work very hard. So an MBA who's 31 years of age can make $500,000 to $1 million. Living expenses are expensive.
Well, I was a 30-year-old working on Wall Street for a big investment bank. I didn't make that much money, but I did work those hours, let me tell you.
You probably worked those hours.
That was a few decades ago, though.
My last trip to New York, these guys roll in at 9 o'clock, 9:30 in the morning. They're not allowed to leave the office. They bring in lunch. So they bring in lunch. They work through the afternoon, and they bring Chinese food or pizza or whatever at around 6:30 or 7 o'clock. These guys work till about 11 o'clock. 10:30. It's been a long 14, 15, 16-hour day. They take them downstairs in a limo and they deliver them home and expect them to come back in the morning. I mean, it's amazing.
We're chatting tonight about the M&A business with Mark Borkowski. We're going to take a break and come back with some concluding comments in just a minute. Stay with us.
Thank you. Hi.
Welcome back. We're chatting tonight with Mark Borkowski. He is the president of Mercantile Mergers and Acquisitions, a M&A firm here in Toronto, and he's been educating us about the M&A business and the trends and what's going on. Mark, sum it up. What do you think is happening?
There's a lot of money in the system looking to deploy. It's not moving into real estate. Real estate returns are capped. The stock markets have their issues and risks. All these big firms, these big money management firms are looking to where the greatest returns are. And today they're in private businesses. They're investing in private equity. So the mergers and acquisitions market and the desire to acquire is going through the roof.
So if I've got a young kid doing an MBA, I tell them to go into private equity?
Absolutely. I counsel all of the people that I'm working with after they've done 2 years of mergers and acquisitions, and they don't want to work doing transactional work, they want more security, go work with one of private equity firms.
Mark, other than giving you a call, what would you recommend someone that's interested in selling their business do? What are the things that one has to do as you get prepared to sell your business?
I think, frankly, I always recommend that people read some very basic books, and I provide them copies of books that discusses the process. And I asked them to go out and seek counsel from other company owners that have sold their businesses to understand the process. It takes, honestly, to sell a business that does $1 million of EBITDA profit, it takes between 8 months and a year to do that transaction. A lot of research up front, preparation of the information, seeking out the buyers. Some people think this is like a real estate transaction, that they're going to put up a sign and it's going to be a company sale. All of this is done confidentially, no names, very discreetly. Anybody that sees our deals has to sign a confidentiality or non-disclosure document. So it's all done very privately, very quietly. And the objective is that no company employees know about this unless the company owner desires that. Because it's when employees think a company's for sale, many people get very nervous and they leave.
For
and
sure.
There's very little to sell after that.
Well, someone, I can't remember who, but one boss told me the line about employees, eagles soar and turkeys squat. So you got to be careful that if the word gets out, all the eagles will be gone and all you'll be left with is the people that spotted.
And that's very much the case. So this whole process is done very quietly, very discreetly. We meet weekends, we meet evenings. We're not seen in the plant during the day, maybe once in a company. So all of these discussions are done very, very discreetly and privately. However, the trend is moving on. I mean, there's so many transactions in the work at the moment. As I speak to the accounting firms, the legal firms, everyone is hot.
And $1.8 trillion.
$1.8 trillion. That's reported money. What about all the other private investors and all the other private sources that don't report?
Of dry powder cash ready to invest. Unbelievable.
Right on.
Mark Borkowski,
lots and lots of money.
President of Mercantile Mergers and Acquisitions Corp. Thank you so much for joining us. Your website, if people want to contact you, is www.mercantilemergersacquisitions.com, correct?
That's correct. Thank you, Brian.
Thank you for sharing your expertise with us, sir.
Brian, this was fun. Let's do it again next time.
I look forward to it.
Thank you,
Brian
Brian.
Crombie Radio Hour, Saga 960, every night, Monday through Friday at 7 o'clock on 960 AM, streamed online at www.saga960am.ca, or on my podcasts and videocasts are on briancrombie.com, Apple Podcasts, YouTube, and even Spotify under the Brian Crombie Radio Hour. Thanks for joining me. Good night, everybody.
Thank you, Brian.
Thank you, Mark.
That was